Okay, let's get into it. Related parties. ISA 550. This is one of those classic boss levels in any audit exam, right? It's pretty much designed to trip people up. But today, we're going to give you the cheat code to absolutely smash it.
Look, we've all been there. It's the middle of the night, you're cramming, and then you hit a topic that just feels intentionally confusing, It's complex, it's risky, and you just know the examiners are going to love it. But seriously, don't worry. We've got you.
Are you staring at a practice question about some director selling his personal yacht to the company for a weirdly high price and you have literally no idea where to even start? Good. You're in exactly the right place. We're about to make this stuff crystal clear.
Okay, so first things first, we need to speak the language. Let's break down the key terms you absolutely have to know, but without all the dense textbook jargon. So what even is a related party according to ISA 550? Well, it's basically anyone, a person, another company, that has enough power to call the shots, or at least heavily influence another company's big decisions. Think parent companies, top execs, or even their close family.
Let's put it this way. It's anyone who can make a business deal feel like a super awkward family dinner, where you can't really say what you think. So if Goku's company does business with his son Gohan's company, bam, they're related parties. That relationship means any deal between them isn't automatically independent or fair.
Now, for the flip side of that coin, the arm's length transaction. This is what we're always looking for. It's a deal done on normal, everyday commercial terms, exactly like it would be if the two parties were complete strangers with no connection whatsoever.
Yeah, it's the total opposite of giving your friend mates rates. The price is the fair market value, no special treatment, no funny business. Baby Vegeta would never sell a spaceship to his rival Goku at a discount just to be nice. It would be full price, probably with a few extra fees just for his trouble. That's arm's length.
So why do auditors get so worked up about all this? Well, it's because related party transactions are a total minefield of risk. The study guide is super clear about this. First, there's a way higher chance of outright fraud. Why? Because management can easily sidestep the usual rules and controls. Second, the deals themselves can be totally bogus, priced to unfairly benefit one person, used to hide shady assets off the books, or even just to create fake sales out of thin air. And finally, even if the deal is legit, the disclosures in the financial statements could be completely misleading or just not there at all.
And now for the good part. Seriously, forget the panic. Here is the simple, 4-step framework that will structure every single one of your exam answers for this topic. This is your cheat code.
It really is this simple, and it works every time because it hits every single point an examiner wants to see. First, you identify who the related parties are. Second, you assess the risks. What could go wrong here? Third, you respond by designing specific audit tests to check it out. And finally, you evaluate the whole picture. Is everything accounted for and disclosed correctly? Identify, assess, respond, evaluate. Let's see it in action.
All right, time for our first boss fight. This is a classic exam-style question where your main job is to spot the red flags.
Okay, so here's the setup. Goku's company sells a warehouse to his son Gohan's company for $5 million. But, and this is a big but, an independent valuer says it's only worth $2 million. The task word from the examiner is explain. That means we need to break down why this is such a problem.
So, let's use our framework. Step 1. Identify the related parties. That's easy. It's Goku and his son Gohan. Now, step 2. Assess the risks. And man, there are a few big ones here. First, valuation risk. Gohan's company now has an asset on its books that's overstated by a massive $3 million. That's a huge issue for the valuation assertion. Second, there's the fraud risk. This could totally be a deliberate scheme. Maybe they're trying to make Gohan's company look way more valuable to get a bank loan, or it could just be a sneaky way to pull $3 million out of Gohan's company and put it into Goku's pocket. And third, you've got the disclosure risk. If this deal isn't clearly laid out as a related party transaction in the notes, then anyone reading those financial statements is being seriously misled.
Okay, let's level up. This time, the examiner wants more than just spotting the risk. They want to know what you're actually going to do about it.
So in this one, Baby Vegeta's company pays his nephew, Majin Buu, $1 million consulting fee. But the invoice is super vague. It just says, for services rendered. The task word here is design, which is a cue that we need to come up with specific practical audit tests.
And this is where we hit step 3 of our framework, respond. To get top marks, you got to be specific. So, procedure 1, we're going to inspect any contract or agreement we can find. We need to see what Majub was actually supposed to do for that $1 million. What's the business reason here? Procedure 2, we inquire with management. We're going to ask Baby Vegeta directly, what services did you actually get and how did it help the company? And procedure 3, we're going to compare that $1 million fee to market rates. Is that a normal price for this kind of work, or is it totally inflated? This is how we figure out if the deal was actually at arm's length.
All right, let's talk about the common traps. These are the classic mistakes that make students lose easy marks, and we are absolutely going to avoid them.
First up, being way too vague. A low-tier answer just says something like, perform procedures on the transaction. What does that even mean? A merit-tier answer, the real glow-up, is specific. Inspect the sales agreement to confirm the price, terms, and business rationale. You see the difference? It has the verb, the document, and the reason.
The next trap is blindly trusting what management tells you. A weak answer just repeats what they heard, but a merit-level answer shows professional skepticism. You don't just take their word for it, you get your own evidence to test their claim. You might do that by, say, comparing the deal to similar ones the company made with completely unrelated businesses.
And finally, a huge one. Failing to link the risk back to the actual financial statements. It's not enough to just say something is risky. You have to explain why it matters. A top-tier answer will always connect it to a specific outcome, like explicitly checking the disclosures in the notes to make sure they follow all the accounting rules.
Okay, let's lock this all in. Time to power up to your final form, so you're ready for any related party question the exam decides to throw at you.
So let's run through that game plan one more time. Remember the 4 steps. 1. Identify the parties. 2. Assess the risks. Is it about valuation, fraud, or disclosure? 3. Respond with specific targeted procedures. And 4. Evaluate the final accounting treatment and make sure those disclosures are spot on. That's it. That's the whole cheat code.
You know, if you remember only one thing from all this, let it be this quote, straight from the Standard. Never, ever, ever just take management's word that a deal was arm's length. Your entire job as the auditor is to challenge that and get the hard evidence to prove it. Trust, but verify. Always.
And there you have it. You've got the framework, you've got the mindset, you've seen the examples, you know the risks to look for, the procedures to design, and the traps to avoid. You're not just ready to answer the question anymore, you're ready to earn every single mark. Go get 'em.